Ever wondered how the ultra-wealthy seem to pay so little in taxes? You might be shocked to learn that there are legal strategies used by the rich to minimize their tax burden, sometimes paying little to nothing at all. In this video, we'll reveal 15 eye-opening ways the wealthy avoid paying taxes. If you don't watch until the end, you might miss out on game-changing financial strategies that could save you thousands. From creative investments to offshore accounts, prepare to be amazed by the lengths some go to protect their wealth. Don't forget to subscribe for more insider knowledge that could transform your financial future. 1. The infinite reinvestment loop. Rich individuals often reinvest all their profits back into their businesses. By doing so, they create a scenario where there's no taxable profit to report. For example, Amazon famously paid $0 in federal taxes in 2018 by reinvesting billions in research and development, effectively eliminating their taxable income. This strategy allows companies to grow rapidly while minimizing their tax burden. 2. The business expense bonanza. Wealthy individuals often use their businesses to write off personal expenses as business costs. Everything from cars to travel can be justified as a business expense if used partially for work. For instance, a real estate mogul might justify a luxury car as necessary for impressing clients, or a tech CEO could write off a home office and associated utilities. 3. The tax haven exodus. Some rich individuals choose to move to countries with little to no income tax. Places like Monaco, Dubai, or the Cayman Islands become attractive residences for those looking to keep more of their wealth. Famous examples include actor Gérard Depardieu, who became a Russian citizen to avoid French taxes, or Eduardo Saverin, Facebook co-founder, who renounced his U.S. citizenship and moved to Singapore. 4. The offshore shuffle. Large corporations often use complex international structures to shift profits to low-tax jurisdictions. This involves setting up subsidiaries in tax-friendly countries and moving money between them. Google's double Irish with a Dutch sandwich strategy is a famous example, where the company used Irish and Dutch subsidiaries to reduce its tax bill by billions. 5. The charitable giving gambit. Donating to charity can be a powerful way for the wealthy to reduce their taxable income. By setting up their own charitable foundations, they maintain control over the funds while reaping tax benefits. The Bill and Melinda Gates Foundation is a prime example, allowing its founders to direct vast sums of money while reducing their tax burden. 6. The equity over salary swap. Many wealthy individuals opt for equity compensation instead of a traditional salary. Stock options or restricted stock units, RSUs, aren't taxed until they're exercised or vest, allowing for tax deferral. Tesla's Elon Musk is famous for taking no salary but receiving substantial stock options, which aren't taxed until he exercises them. 7. The art of tax deduction. Investing in art can be a clever way to defer or even eliminate taxes. By purchasing art and later donating it to museums at a higher appraised value, the wealthy can claim significant tax deductions. For instance, a hedge fund manager might buy a painting for $1 million, wait for it to appreciate, then donate it to a museum at a $5 million valuation, claiming a $5 million tax deduction. 8. The nomad's tax dodge. Some ultra-wealthy individuals maintain multiple nationalities and no fixed residence, making it difficult for any one country to claim them as a tax resident. This strategy, while complex, can result in paying little to no income tax. For example, some yacht owners use their vessels as primary residences, moving between international waters and tax-friendly ports to avoid establishing tax residency anywhere. 9. The gift-giving loophole. The wealthy often use gift-giving strategies to transfer wealth without incurring gift taxes. In the U.S., individuals can give up to $15,000 per year to as many people as they want without triggering gift tax reporting. Over time, this can allow for significant tax-free wealth transfers. A wealthy grandparent, for example, could give $15,000 to each of their grandchildren every year, potentially transferring millions tax-free over their lifetime. 10. The crypto conundrum. Some wealthy individuals are turning to cryptocurrencies, particularly privacy coins, to move and store wealth with minimal oversight. While not necessarily avoiding taxes, the anonymity of certain cryptocurrencies can make it challenging for tax authorities to track transactions. For instance, coins like Monero or Zcash offer enhanced privacy features that some users leverage for tax avoidance purposes. 11. The asset-rich, cash-poor strategy. Many wealthy individuals keep their wealth tied up in non-liquid assets, borrowing against these assets when they need cash. Since loans aren't considered income, this strategy allows them to access funds without triggering taxable events. For example, a tech billionaire might take out a low-interest loan against their stock holdings instead of selling shares and incurring capital gains taxes. 12. The strategic bankruptcy play. Some wealthy individuals use strategic bankruptcy to protect their personal assets while writing off business debts. By structuring their affairs correctly, they can shield personal wealth from business failures. Donald Trump's multiple corporate bankruptcies, which didn't affect his personal wealth, are a well-known example of this strategy. 13. The yacht as a second home trick. Wealthy individuals sometimes claim their yachts as second homes to take advantage of mortgage interest deductions. As long as the vessel has basic amenities, it can qualify as a residence under tax law. For instance, a Wall Street executive might write off the interest on a multi-million-dollar yacht loan, potentially saving tens of thousands in taxes. 14. The trust fund tax shield. Using trusts, the wealthy can pass on assets to heirs while minimizing estate taxes. By placing assets in certain types of trusts, they can remove them from their taxable estate. The Walton family, heirs to the Walmart fortune, famously used grantor-retained annuity trusts, GRATs, to transfer billions in wealth while avoiding significant estate taxes. 15. The depreciation deduction gambit. Wealthy individuals often use depreciation on real estate or business assets to offset income on paper. This accounting practice can result in showing losses for tax purposes, even when the underlying asset is appreciating in value. Real estate moguls like Jared Kushner have reportedly used depreciation deductions to pay little to no federal income tax for years, despite owning valuable and appreciating properties. If you're intrigued by these strategies for financial optimization and want to learn more about achieving financial freedom, keep watching our previous videos. They tackle even more ways to grow and protect your wealth, with surprising insights that could change your financial future. Don't miss out on these game-changing strategies. Click the link in the description to access our full playlist on wealth building and tax optimization techniques.